Welcome to 18.1, which is on short-term debt financing. So essentially, what we are doing in this lesson is talking about the sources of debt financing and also journalizing transactions that are related to short-term debt financing. So first off, we should know by now that every business needs cash to pay its operating expenses. And remember that operating expenses are just the expenses that take place in order to run our business. Things like purchasing inventory or paying for payroll are all examples of daily activities that require a business to earn revenue. So the payment of an operating expense necessary to earn revenue we call a revenue expenditure. Okay. And over an extended period of time, a business is going to have to generate enough cash from sales to have to pay these expenses. However, we know that cash um, isn't always there when we need it to be. So a business may find itself short on cash from time to time, and when this happens, we might have to borrow money for a short period of time. So when we have to borrow money for a period of time, we call that debt financing. And there are multiple ways that we can borrow money, either from a bank or from a financial institution. A bank loan that gives us immediate short-term access to cash is called a line of credit, or sometimes referred to as a credit line. And essentially what this loan agreement does is it sets up a maximum amount that can be borrowed and the repayment terms. It's also going to set an interest rate and the length of time for an agreement. And then the business can draw on that amount anytime it needs to. So you don't have to continually go back to the bank for this. It just essentially is an account of yours, and you can borrow from it at any time. You have to pay it back within a certain amount of time, but it's kind of like a credit card through the bank, essentially, is that you can continue to use that amount again and again if need be. The interest rate that gets charged on a line of credit actually changes based on what the market interest rate is. So the interest rate that gets charged to a bank's most credit-worthy customers is called the prime interest rate. And interest rates are often based off of the prime interest rate. So the prime interest rate is like for the best of the best in terms of a bank's customers. Okay? A business needing to borrow money might elect to sign something called a promissory note. And that gets recorded for us as the business as a note payable. It means that we now owe people money. Okay, that note obviously is going to state the principal, which is the amount that we borrowed, the interest rate, and then any repayment terms that are there. Unlike a line of credit, a note is actually specified for a specific number of months and the interest rate is fixed, whereas with a line of credit, the interest rate can change. A business has arranged to withdraw a line of credit with a bank that provides a company with immediate access to a maximum of $50,000. That business can then transfer that money from its line of credit to its checking account using online banking, or you can call the loan officer at the bank. And then what happens is that the business pays an annual interest rate on its daily balance. And that line of credit requires the business to pay a monthly interest at least 10% of its outstanding balance. Oh, that should say at the end of every month. So that's kind of setting us up for the problem we're going to look at here. So here it says we drew $15,800 on its line of credit, and it gives us a receipt as well as the date. So our cash goes up because that's what we needed was short-term cash, right? The other thing that goes up is a liability called a line of credit, which is for $15,800. So when we put this, we're going to put it in our cash receipts journal because we're receiving cash. And our account title is going to be line of credit. That's what's going to get credited. And then cash is going to be debited in this instance. Okay. If there comes a time where you're not able to pay your account when it's due, you might ask the vendor for an extension of time. And the vendor may ask the business to sign a promissory note if that happens. Anytime you ask for an extension for something, people usually want you to sign something to make sure that you're actually going to pay them. What the note does is it does not pay the amount that's owed to the vendor. But that form of the liability gets changed from an account payable to a note payable, okay, which essentially just means that we replace one liability with another. Okay, the interest rate on the promissory note gets signed with the vendor could be rather high. Okay. So what it looks like when we sign a promissory note for an extension of time, here it talks about the company Sun Treasure signed a 60-day 12% note to Haas for an extension of time on its account payable, which was $4,200. So what that looks like is we take our 4,200 out of the accounts payable and we put it into instead a note payable $4,200. Like I said, replacing a liability with a liability. Note that we also have to take it out of the Haas Inc. for $4,200. And so what that looks like here is that we have our accounts payable slash Haas Inc. in our general journal. We have to do the slash in the post reference. That gets debited, meaning it's going down for $4,200, and our notes payable gets credited for $4,200. So notice too how high the interest rate is. Note also that we're not calculating this right now. All we're doing is switching it out of the accounts payable and putting it into the notes payable. Now, when we actually end up paying the principal and the interest on a promissory note, once it reaches maturity, that's when we have to pay the payee. So interest incurred on borrowed funds we call interest expense. Okay, the interest incurred on a note gets debited in an expense account titled interest expense, which we've worked with before. Expenses that are not related to a business's normal operations are called non-operating expenses. Okay, interest expense is one of those because if we were operating, we would be having sales. Instead, this is non-operating, so this is where we have interest expense goes in non-operating. So on November 29th, we paid cash for the maturity value of our August 30th note for a principal of $4,200 plus our interest of $84 with a check. So what that looks like is we have to calculate, this shows you how we calculated it out. So $4,200 times the 12% interest rate times the fraction of the year, which it was August 30th through November 29th, which is 60 days. And when we do that, we have $84. So our notes payable gets debited for $4,200. It's going down. Interest expense goes up for $84, and then cash goes down. The other credit goes down for the total of those two, $42.84. So what that looks like here is on the 29th, we record this notes payable at $4,200 and our interest expense of $84 for a total of $42.84. Just ignore this one down here. That's going to be soon. Okay, and then obviously our check number of $751. And that should do it. Let's do 18.1 together, work together in Aplia next.